So, Japan's trillion yen gamble. What's it all about? Well, we're diving into a story that kicks off with a policy decision in Tokyo, but believe me, it sends these massive shockwaves across the entire globe. It's a huge bet, and the fallout could affect pretty much everyone.
And that brings us to the big question, right? Could a decision made in Tokyo actually be the trigger for the next global market shock? I mean, think about it. One country trying to fix its own economy, but accidentally kicking off a crisis for the rest of us? Let's unpack exactly how that could happen.
Okay, so where does this all start? It kicks off with what you might call a massive splash of cash. We're talking about a huge government spending plan designed to get Japan's sputtering economic engine firing on all cylinders again.
And when I say massive, I mean it. We're talking about a stimulus package of at least 17 trillion yen. Now, to put that into perspective for you, that's more than 110 billion US dollars. It's actually the biggest stimulus package the current government has ever pushed through. It is a staggering amount of money.
So you might be wondering, why go so big? Well, honestly, the alternative looked pretty grim. Japan's economy actually shrank last quarter. We're talking a 0.4% contraction. That was its first dip in a year and a half. So policymakers are basically in a position where they feel they have to spend their way back to growth. And the market's reaction? Oh, it was immediate and it was dramatic. See, to fund all this spending, the government has to borrow money, right? It does that by selling bonds. But when the market saw this absolute flood of new debt on the horizon, it basically said, whoa, if you want us to lend you that much money, you're going to have to pay us more. And the result? Japan's 30-year bond yield, basically its long-term borrowing cost, shot up to a record high.
And right there, that spike in borrowing costs, that is the key that unlocks this whole global story. Because you have to understand, for decades, Japan has basically been the world's ATM, just spitting out cheap cash for investors everywhere. And now, it looks like that ATM is finally closing for business.
The way this all worked was through something called the yen carry trade. It's actually a pretty simple concept. Imagine you're a big investor. You could borrow Japanese yen for next to nothing, like at almost 0% interest. Then you take that super cheap money and go buy assets somewhere else that pay way more, like US bonds or Indian stocks. The difference between what you pay in interest and what you earn, well, that's pure profit.
And the sheer scale of this is just mind-blowing. We are talking about over $1.2 trillion. Trillion with a T. That's how much money was flowing around the global financial system, all thanks to this one trade. And now all of that liquidity is suddenly at risk.
And this is a great way to see how the math has completely flipped. In the before picture, borrowing in Japan was dirt cheap, and the profit margin on investing elsewhere was huge. But now look at the after picture. Those Japanese borrowing costs have shot up, and that juicy profit margin, it's just disappearing. When the trade stops being profitable, investors have no choice. They have to unwind it, which means selling all those foreign assets and bringing the money rushing back home to Japan.
So what happens when over $1 trillion suddenly decides to go home? It doesn't just leave quietly. It creates a vacuum. And the very first, and maybe the biggest, shockwave from this whole thing travels right across the Pacific and slams into the United States.
Let's break down how this contagion spreads step by step. First, those higher interest rates back in Japan suddenly make it way more attractive for Japanese investors to just keep their money at home. Why risk it abroad? So what do? They start selling their US government bonds, and they own a ton of them. All of a sudden, there's a huge drop in demand for US debt. And when demand falls, the US has to offer higher interest rates to find new buyers. This pushes up borrowing costs, not just for the US, but for literally the entire world, because US rates are the benchmark for everything. And here you can see that whole domino effect laid out perfectly. It all starts with that one little push, the stimulus in Japan. That knocks over the next domino. Japanese bond yields rise. That hits the next one. Demand for US bonds falls, which in turn pushes over the next one. Global borrowing costs go up. And the final domino to fall? Investors get spooked and pull their money out of places like India. It's a perfect, scary, global cascade. Okay, so this all sounds a bit abstract, right? Global cascade, shockwaves. Let's make it real. What does this actually look like for a country on the receiving end? Well, for a case study, we don't have to look any further than India. And listen, this isn't just some hypothetical theory. This has already happened. We have a real-world test case from just this year. The Bank of Japan made one tiny little rate hike, and it triggered a 6% drop in India's Nifty stock index within a month. It's proof positive of just how incredibly sensitive these markets are to even the slightest change in Tokyo. And India's exposure here is huge. We're talking about Japanese investors holding over $180 billion in Indian stocks. Think about that footprint. We even saw a preview of this last year, when a tiny unwind of this carry trade caused the biggest weekly outflow of funds from India in 2 years. A huge chunk of the recent rally in Indian stocks was powered by this cheap yen. And the scary part is, what flows in that fast can flow out even faster.
So this chart really gets to the heart of the problem for a country like India. It's something called spread compression. Look, historically, investors were willing to take the extra risk of investing in India instead of, say, the super safe US market because they got paid a lot more for it. That's that big green bar, the yield spread. But as global interest rates rise, that extra compensation, it starts to shrink. And pretty soon, investors look at this and go, wait a minute, why am I taking all this extra risk in an emerging market if I'm barely getting paid more for it? And that's when the money leaves.
All of this brings us to the tipping point, the climax of this whole story. It all comes down to the incredibly difficult, almost impossible decision that is now sitting on the desk of the Bank of Japan. And yep, you can circle a date on your calendar for this one, December 19th. That is the day the central bank makes its next announcement. And you can bet that traders and investors from New York to Mumbai are going to be holding their breath. The Bank of Japan is truly caught between a rock and a hard place. I mean, look at their choices. On one side, you've got high inflation, which is screaming at them to hike interest rates and cool the economy down. But on the other side, you've got that shrinking GDP we talked about. If they hike rates, they could completely crush their own stimulus plan and send the economy into a nosedive. There is just no easy, painless answer here. So what could happen? Well, analysts have basically game theoried this into 3 main scenarios. Scenario 1, they hike rates. That would probably trigger a high-stress event, a really fast and messy unwind of that carry trade. Scenario 2, they do nothing, just hold steady. That leads to maybe moderate stress, because the uncertainty just continues to hang over the market. Or Scenario 3, they come out and very clearly say they're not going to hike for a long, long time. That would probably calm everyone down for now, but it might just be kicking an even bigger can down the road. And all of this really leaves us with one final and, frankly, enormous question. For decades, the entire global financial system has been running on this foundation of super cheap money from Japan. It's been like the oil in the engine of global growth. So what happens to all of us when the world's ATM finally, officially runs out of cash?